good. This is Gary Kokens. I'll be one of the presenters. Robbie Williams will be the host. We'll start in 2 minutes, 2 minutes on the top of the hour, waiting for other people to come in. You're in the right place. Okay, let's go. My name is Gary Kokens. I'll be the key presenter. Carlos Polito will be joining me to do some of the information about SAP and how it basically handles the top trends. In a minute, I'm going to introduce Robbie Williams with ERP Fixers. He'll share a little bit about that organization. But I'd like you to write down, if you have questions, there's not going to be much time at the end. It's a long presentation. Write down my email address and Carlos's. It'll also be the last slide. You can directly email us with questions. Alternatively, Robbie will take any questions in the chat box, copy them into a Word document, send it to me, and I will answer them in 24 hours to get back to you. So we'll do the introductions in a second, but let me have Robbie do a quick introduction of ERP Fixers. Take it away, Robbie.
Thank you so much, Gary. Hello, everyone. I'm really excited to be here today and experience this webinar. So I'm from ERP Fixers. What we do is we provide top quality experts in the core centers of the SAP modules. So some of our offerings consist of SAP implementation and support, SAP best practices and assessments, material ledger conversions, enhanced cost component reports, S/4HANA traditional roadmaps. Whatever you need, we make sure that we provide you with the services needed. So if you want to learn more about us, please visit our websites, ERP Fixtures. You can find us on LinkedIn and be sure to reach out. So thank you, Gary. Thank you, guys. Let's have a good webinar.
Okay, let's go. Put on your seatbelts. This is going to be fast and furious. First, a little bit about me. Who am I? I'm Gary Kokens. I received my industrial engineering and operations research degree from Cornell in 1971, my MBA from Northwestern's Kellogg School of Management in 1974. If you're doing the math, I am 74 years old, but I feel like I'm 44 years old. My career was in 3/3. My first decade or so was with a large manufacturing conglomerate, FMC Corporation, Link Belt. Then many years with Deloitte Consulting, 7 years with Deloitte, 5 years with KPMG, 5 years with EDS. And then for 16 years, I was with SAS, SAS, and most people don't know what SAS. It's actually the world's largest privately owned software vendor, 15,000 employees here in Cary, North Carolina area that specializes in analytics. I'm a native of Chicago, go Cubs, go Bears. Why are those books there? Long story. But I think careers have a lot to do with luck and circumstances than being smart and competent. In 1988, KPMG struck an exclusive contract with Harvard Business School professor Robert S. Kaplan. Many of you will recognize his name from the balanced scorecard, which we will talk about. And they recruited me to be trained by him. I implemented activity-based costing. That was the training for 5 years. Wrote one book that led to other books. And I'm not advocating you buy the books. I don't want to get criticized. If you go to Wiley, chapter 1's a free download. You don't have to buy the book. You can get a free loan. Now about Carlos, my colleague. Carlos has been a consultant for 25 years. Began with Arthur Andersen, those of you who remember those days before Enron collapsed them. He's currently a managing director with Bintech. It's a consulting firm that specializes with SAP. He got his BSc from St. Michael's and an MBA from the University of Notre Dame. There is his website, email address. So let's go. Who will benefit from this presentation? Managers who have previously struggled at promoting financial planning and analysis, enterprise and corporate performance management methods, EPM, CPM, and integrating business analytics with digitization into their decision support systems. Managers who intend to champion any or all EPM, CPM methods and business analytics improvement techniques, and they need a compelling call to action. And the reason I have championed quotation marks is it's been my observation that although it's good to have senior executives advocate innovation and new ideas, often they are preoccupied with firefighting and short-term priorities. It's typically managers 2, 3, 4 levels down in the organization chart who ask themselves, how long do we want our organization to perpetuate using stale or arcane or flawed or out-of-date methods? And they're the ones that'll do a pilot project or a proof of concept to demonstrate to their colleagues that this is the way to go. So if you're 3, 4 levels down in the org chart, that's fine. We present to you. So what are these trends? I'm going to go through the multiple trends. The first one is the shift from being product-centric to customer-centric for profitability analysis. Products and standard service lines are not the only thing for which accountants should compute costs for. What about all the costs that have nothing to do with making the products and delivering the standard services? Things like channel distribution expenses, marketing expenses, selling expenses, and so forth. The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture, what's below that line, the distribution, marketing, selling expenses. I'm going to make a case that that's more important than the top line. The way it gets resolved, though, is with activity-based costing. So here's a simple definition of ABC. Imagine you go to a restaurant with 3 other friends. You order a little salad, and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines in a service organization also feel when the accountants take this large amount of indirect expense, commonly called overhead, and they allocate it like spreading butter across bread using cost allocation factors like number of labor hours or number of units produced or sold or full-time equivalents, number of employees, square feet, square meter. None of those cost allocation factors reflect the unique consumption that the diverse products consume of the end-to-end business processes and the work activities that belong to them. So if you were to decompose those overhead indirect expenses into multiple cost pools and trace and assign them with a cause and effect relationship, you'll discover, compared to that butter spreading, in reality, some of the products were overcosted, the others must have been undercosted because it's a zero-sum error game. So the simple definition of ABC is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. Now, what's led to ABC over the last 50 years has to do with this diagram. It has the 3 universal components of any organization's expense and cost structure. At the bottom, we've got the direct, and I call it recurring labor because service organizations like banks, insurance companies, they say, oh, this is about manufacturing. No, ABC is applicable to any organization, including government public sector. The second one is the material, and then there's the indirect expense. In this diagram, notice the indirect is displacing the direct. When you ask people why, they'll say, well, maybe automation, we're automating the jobs of the frontline direct workers. That's secondary. The main reason for this displacement is over time, all organizations have had an increased proliferation of different types of products or services, manufacturers, more colors, more sizes, more ranges. And the point is this: whenever you introduce more diversity and variation in your outputs, it just produces complexity. And the complexity requires more and more of the indirect expense to manage it. So, 70 years ago when the product was maybe homogeneous, just one, the indirect was so small, thin veneer, most of the accuracy came from the direct. But now look to the right. That's not the case now. So we need to basically apply activity-based costing to assign it. Now, the problem actually begins with the first diagram here on the left, the responsibility cost center statement. Every manager on the planet Earth recognizes this statement, salary, equipment, travel, and so forth. The problem is, though, when they ask themselves, how much insight and understanding do I get from this report about the cost that I can manage and control, or where does it go? It can't answer it. I say when managers get this kind of report, they're either happy or sad, but they're rarely any smarter. And it's not that it's a bad report, it's just that the data is not structured in a way that can answer the question. So what Activity ABC does is it converts the same 914,000 to the middle into the language of work, key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And then it reassigns those activity costs to the products, the service, and the customers, just like the waiter and the waitress in the restaurant, based on a cause and effect relationship. Now, it isn't quite as simple. I've rotated the previous diagram 90 degrees. It isn't like, oh, you just take your ledger expense accounts, put them in activities, cost objects. No, it's a little more complex. Look to the right. You've got support departments that support other support departments that ultimately support the frontline departments. So it really needs to be a multi-stage cost assignment network. Now, I want to warn you, the next slide is going to look complex. I'm going to go through it in a minute, but the one that comes after is going to point you to a link where you can read a 30-page paper that I wrote on this that'll convince it. That'll be easier for you to understand. So here it is. It has the three universal, if you will, modules of any costing system. We've got the expenses at the top, and we calculate the activity costs in the middle, and then they eventually pile up in the bottom into the suppliers, the products, the services, the customers, and something called business sustaining. Okay, think of all those arrows as thin straws or wide pipes, where the diameter reflects the amount of money flowing through. That's why this reconciles exactly to the bottom. So if the organization, let's say, spent $2 million in January, it'll have the exact same $2 million or euros of activities. And that 2 million will pile up into the bottom right two boxes, the customers and the business sustaining. The bottom one is like a predator food chain. Large mammals eat small mammals eat plants. Once we have the products and services costed out, notice the customer is buying them. That would come from the sales register, the volume and mix that they bought. Business sustaining is a special category. There will be some expenses that have nothing to do with customers or products, things like the legal department. So they're not causing them. So typically it's about 10% of expenses. So we put them into a special category there because we don't want to allocate those business sustaining expenses to products or customers. That will overcost them. The message here is costing is modeling. It's not T accounts and journal entries from a ledger. Direct cost, not broken. You may have data integrity issues there, but that can be resolved by the IT department. And I mentioned to you, because I went through that really fast, I spent 30 years and have spent, still a member of the Institute of Management Accountants, and I authored what's called a Statement of Management Accounting, how to implement ABC. There's the link. When you get these, I think ERP Fixers will be providing you the link to this presentation PDF. You can take your time to read it. So what's the consequence when you do ABC? The vertical axis in the diagram is the percent error distortion. Now, the horizontal axis would be the traditional butter spreading allocation. The kind of the backward S is what you get from ABC. So notice to the left, basically simple products like you in the restaurant, you'd be subsidizing those other three with the expensive meals. They've actually been overcosted. So there's really hidden profit there. For the complex products and services that require more and more of the indirect, they've actually been undercosted using the butter spreading. So there's hidden loss. And it's really substantial. The error is not 5 or 10%. It can be 30, 40%. And you'll notice to the left, the risk of basically the butter spreading is competitors who now understand that you have priced yours wrong. They will price maybe 2% under and grab market share from you. Now, to the right side, it's even terrible, more terrible. The sales force is being misled that certain products or services are very profitable. In reality, they're not. They may even be unprofitable, and they're selling more and more of it. Now, here's a diagram from a real company that shows the results of ABC. The diagram is the vertical axis is the net revenues minus the properly calculated traced ABC costs. The horizontal axis is the cumulative buildup of the profit, but it's rank ordered with the most profitable product, second most profitable product, and so forth. The very last data point at the right will exactly reconcile with the P&L of the company. These are often referred to as a humpback whale curve, and it's always organization shock when a company sees the reality of the top line. Because in this case, it said, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable products. You lost $6 million on the remainder to net out a 2. But their belief system is it was that blue line. Oh, yeah, we make money on everything and then a little bit losers at the end. And the problem is all that butter spreading was crushing and suppressing any accuracy, and the multi-stage cost assignment network from ABC was detecting it and showing the top line. So now some of you may, here's the point though, at least the top line is fact-based data. And if you remember anything from this ERP Fixers webinar, remember this: in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of the boss or the boss of the boss. So to the degree they're making decisions on gut feel or intuition or flawed or misleading information, the organization's at risk. Now, all of that was to set you up for this trend number 1 about customer profitability. The only value a company will ever create is the value that comes from its customers, the current ones and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like the ones you have today. But we have a problem. The CFO and the accountants are not calculating. They're stopping halfway down at the gross profit margin line. So as I mentioned, the problem with it is you don't see that bottom half of the picture. Now, visually, what I'm showing here is the big rectangle would be the total expenses, let's say $2 million in January. The accountants are only calculating for the shaded box. What about the distribution, sales, marketing, G&A? That is much more important. Now, why? Angel customers and demon customers, this book. Every company has high and low maintenance customers. So example of the high maintenance customers, either the demons, always changing delivery schedule, always demanding special, not standard product, always returning goods, always calling help desk. The low maintenance customers, the angels, we love them. Never change schedule, delivery schedule, only buy standard, never call help desk, never return goods. If those two customers bought the same volume, same mix at the same price, they're not equally profitable because the high maintenance ones are causing you so much work. So the message here is sales volume is not synonymous or equivalent to profit. But what really caught my attention about this book was the subtitle, Discover Which Type of Customer is Which and Turbocharge Your Stock Price. So the message here is customers are the source of financial wealth creation for shareholders. We have to make that connection. Now, here's some of the contrast between profitable and unprofitable customers. Less profitable customers, small order quantities, ordering special, heavy price discounting, unpredictable demands, changing in delivery times, high technical support, slow pay. The angels, we like them. They're more profitable, large order sizes, only standard, little or no price discounting, very predictable demands, delivery time standard, low, maybe no technical support. They pay on time. This behavior can be measured with activity costs. Now, here's a decomposition of the multi-stage cost assignment, or it's in that 30-page paper. I'm not going to go through it, but the message here is as the activity costs come in from left to right, notice profitability is being stripped away. And with this, we can then produce a profit and loss statement for each individual customer. And you'll notice in this fictitious customer 1270 that there is a 30% composite profit margin at the product and service level. But between the 30 and the 8, 22 more points of profit are eroded, stripped away, nothing to do with the products and services, but with the channel distribution, selling, and marketing. So if you calculate just those two broad swaths for every customer, you can put them on a grid. that looks like this, where each circle intersection is a customer. Now, the vertical axis is the product mix, product gross profit margin, okay, above the line. And the horizontal axis, the angels on the left, the devils on the right. And now things become obvious. The most unprofitable customers are in the bottom right because they're buying low margin mix with you and they're difficult to serve. The best profitable customers are in the upper left because they're buying high margin mix from you and easy to serve. And now the name of the game is move the dots from the bottom right to the upper left. And that would be another webinar for ERP fixers for marketing and salespeople, how to do that. Although one of the examples they would give is unbundling and fee-based, like the airlines. They charge for baggage now, or they charge you want to go from a middle seat to an aisle seat. What really caught my attention, as I mentioned, though, is that subtitle. Why? Because you can destroy shareholder wealth creation in two ways: by overspending unnecessarily on loyal customers for what is needed to retain them. They would have bought the same volume and mix anyway, so you wasted money. But you can also destroy shareholder wealth by underspending on marginally loyal customers and risk their defection to a competitor. So the trend here is what's the optimum spending for each micro segment, and the accountants, if they would use ABC, can help sales and marketing do this. Now, some of you may be saying to yourself, gee, Gary, I've heard that ABC is too big, too complex, doesn't work. And sadly, that was in the past. That's because consultants and companies were building models way, way too large. I came up with a solution 20 years ago, how to implement ABC successfully in 3 weeks. You start with model 0, meaning 5, 6, 7 cross-functional employees in a room. You build a high-level model, ABC, very quickly. The next day, you bring in their line managers and executives. They see it, very engaging. The light bulbs go on with everybody. Oh, that's how we can see our profit margins. Oh, that's how we can validate our pricing, and so forth. 2 or 3 iterations, you get to a permanent, repeatable production system. Make your mistakes early and often, not later when the system is to change. Later, I'm going to introduce Carlos Polito. He's going to show you some screenshots from SAP. Carlos and I do this rapid prototyping for our clients. If you're a consulting firm, contact me. I can train you how to do rapid prototyping so your client can have a repeatable production ABC system in 3 weeks. Now, why does rapid prototyping work? Excuse me. It has to do with this diagram. The vertical axis is the accuracy of what you want to know. Let's just say it's product cost. The horizontal axis is the level of administrative effort to collect the data, calculate the data, validate the data, report the data. You'll notice you've always got an asymptotic curve, meaning the accuracy goes up relatively quickly, hits that elbow, and then to the left, to the right, diminishing returns on extra accuracy for the extra effort of work. ABC basically gets that accuracy. The most of the accuracy that influences the slope of that line comes from the multi-stage cost assignment network. It's not timesheets. It can really handle estimates, percentages, 30, 30, 40, 10, 10, 80. It works. So it's good enough for you to basically start using ABC to make better decisions. All right, that was a long one. Trend number 2 of the 7, predictive accounting. How we move from traditional budgeting to rolling financial forecasts and what-if scenario analysis. Now, there is a problem with the existing budget. The budget's a typical fiscal exercise done by the accountants. It's got 2 problems. It's disconnected from the strategy of the executives, and it's not volume sensitive. It's basically kind of static, And I'm going to show you how you can use enterprise performance management methods to replace the actual annual budgeting process, which I think is broken, with a far superior driver-based way. Now, here's some of the problems with budgeting. How many of these boxes would you check for your company? Our budget is invasive and time-consuming with few benefits. It takes 6 months from beginning to end. We start in June till we can publish it the following December. It requires 2 or more executive tweaks at the end. When we give the first draft to the executives, they say, not good enough. Change some of the numbers, higher profit. It's out of date in a couple of months after you basically produce and publish the thing. It starves the departments with truly valid needs. Maybe in this next fiscal year, our departments had a shift toward workload. We didn't allow them to add enough employees. it caves into the loudest voice in political muscle. That's the gray hairs like me, white hairs. They've been around. They know how to play the game and pad their budget just in case they spend more. They don't want to get in trouble. It incorporates last year's inefficiencies into this year's budget. So if our process was inefficient last year, it's going to be inefficient this year. The one that bugs me the most is this last one. When a manager is 3-4 months away from the end of the fiscal period and they can see on their glide path they're not going to spend all of the budget that was allotted to them, what do they start doing? They start spending needlessly, foolishly. Why? Because they know that the budget for their next year is going to be pegged for the baseline of how much they spent this year. We call it use it or lose it spending. It's ridiculous. So how do we basically improve on this? Think about the amount of money needed to be spent is the result of two river streams coming at the organization. The upper river stream is the recurring, repeatable expenses. It's going to be demand-driven, customer demand. The lower river stream is going to be non-repeatable, non-recurring expenses. It's going to come from projects. And in a minute, I'm going to show you 3 types of projects. So for the upper river stream, the way that we can basically improve the operational budget is we get our ABC system used strategically for profit margin analysis, but we get a bonus. We get unit level cost consumption rates. What's the cost of taking an order? What's the cost of material move? What's the cost of processing an automobile loan? And so forth. And then we basically calculate backwards. I call this Industrial Engineering 101. I think it was my second semester freshman year at Cornell University. Here's the equation. The sales demand volume and mix times the unit level cost consumption rate equals the capacity required, meaning the number and type of employees and their salary and wages and purchases. So by forecasting the sales, running it through the assumption rate, we can know what is going to be the operational load. Now, let's talk about the non-repeatable below. I didn't go through the strategy map balance scorecard, but which Kaplan and Norton created. But when you create a strategy map, in it are these 4 perspectives: learning and growth, the process to customer to financial. Each of the strategic objectives, 2 or 3 or 4 of them in them, has 5 components. These are the vertical axis. Okay. What this is saying is the executive team, obviously, they have to define the strategic objectives in the map. But the next step, it is best to delegate to the managers and employees what are the projects and initiatives to accomplish those objectives, and then have them define the KPIs. Then the targets can go back to the KPIs. Why do we want managers to define the KPIs? Because they're going to be held accountable. They're going to have to live with them. But now notice, if we fund the projects and initiatives, we've now connected the budget with the strategy of the executives. So that's a good way to go. Now, another type of project are risk management projects. Here is a popular diagram by the enterprise risk management community. The vertical, each of the circles is a type of risk event that will happen in the future. The diameter is how much is required to mitigate that risk. So the vertical axis is the severity, the impact if the risk event was to occur, how painful. The horizontal axis is the probability. Now, you can't spend money for every single possible risk, but at least the ones in the upper right that are going to be painful and probable, we can spend money to mitigate them. And then there's the capital budget you're all familiar with. So let's revisit the river streams. For the upper river stream, the way we basically calculate it is calculating the cost model backwards. Remember the ABC model backwards based on the forecast volume and mix times the unit level rates. At the bottom, for the non-recurring expenses, we've got the strategic projects to connect to the budget. We've got the risk mitigation projects, and we've got the capital projects. That's going to be a much better number to the right. Now, what are we comparing this to? How do most organizations do their budget? See if I describe how you do it in your organization. You give every manager a spreadsheet, of a cost center, January to December, every line item of the ledger expenses, including paper clips and rubber bands. They fill them out. And then someone in the accounting department consolidates all of them. You bring in the forecast from the sales department, gets a P&L. You give it to the executives. They look at it and they say, well, that's okay, but not good enough. We need more profit. So you give the spreadsheets back to the managers. They lower some of the expenses in their accounts. back to the consolidation, back to executives. That's a little bit better, but not good enough. Up, down, up, down, up, down, up, down. Come on. You almost want to ask the executives, what number did you want in the first place? So we don't have to go through all this spreadsheet stuff. But that would give us their aspirations, not what they really basically is feasible. So I'm going to decompose that diagram. This is the much better way to get at it. The shaded boxes are the upper river stream. We start with the management accounting. We basically get to we bring in our forecast of the drivers. We bring in our unit level consumption rates. That gives us the capacity resource plan, number of person hours, pounds, kilograms, number of employees, and so forth. We then monetize it. That gives us the operational budget. Notice for the bottom left, we've got those three, if you will, project related, the capital projects from the budget. We've got the strategy projects, risk budget. That is going to give us a much better number than those spreadsheets. But we still will have a problem. Notice when the executives get it, they may say, not good enough. The temptation for them might be to basically eliminate or postpone the capital projects. No, we already justified it. Eliminate or postpone the strategy projects. No, that basically we won't achieve the strategy. Eliminate or postpone the risk projects. No, that exposes us to risk. The major lever that you could basically lower that profit is the unit level consumption rates. And that's where process improvement, lean management, Six Sigma, the process improvement people come into play. Now, you do need to basically think like an industrial engineer when you do the predictive view, because you need to classify the behavior or the capacity as sunk, fixed, step fixed, or variable. And that classification depends on the planning horizon, because in the very short term, 1 day or 1 week, you can't remove people, you can't change capacity. But as you go out weeks, months, quarters, you could replace full-time employees with contractors. You could basically lease assets that you might have purchased. So they become variable. You got to think like an engineer. All right, the next trend, lean accounting. Some of you have heard this term. I will share with you, I'm not a big fan of lean accounting. Well, no, I'll say it another way. It's okay to do lean accounting, but don't be exclusive. You do lean accounting and ABC at the same time. They can coexist. And if you want to read more about this, again, here's a link to an article I wrote about lean accounting and activity-based costing, choice or blend, meaning you can do the two of them together. And how does it work? Here is a simple view of that multi-stage cost assignment network. Notice in the middle, each department has activity zones of the X's. So the vertical view that I already described in trend 1 for customer profitability, we're tracing and assign them to the products, orders, and types of customers. But notice we can string the activities end to end like pearls in a necklace and get the process view. And what that then allows the lean management Six Sigma people is to put it into what's called a value stream map. Notice each of these, if you will, cylinders, the height is the amount of money of an activity, and then they like to tag or score them as value added, non-value added, and other types of attributes, so they can focus on where are opportunities to reduce costs. Now, trend number 4. Whoa, hold on. Trend number 4, why is the adoption rate so slow? Because people are not implementing activity-based costing. It's really, in my mind, it's pathetic. They really do require it. One of the barriers are technical barriers. They're IT related, poor quality data, but there are tools by the IT department called extraction, transform, and load, ETL, that can basically purify the data. The second one is the perception barrier, that it's too complicated and it's unaffordable. But I already showed you that with rapid prototyping, you can create and construct an ABC model in 3 weeks, not 6 months. But the biggest barrier that is slowing the adoption rate of all these methods has nothing to do with technology, nothing to do with systems. It's all about people. And it starts with resistance to change. It's human nature. People like the status quo. Only babies like change, with their diapers. But other issues, fear of others knowing the truth. Oh, I don't want the other departments or managers to know what my costs are. Fear of being held accountable. Fear of being measured. Weak leadership. There, I said it. Not every company's executive team has the highest IQ. So if you want to be successful implementing, and the trend is having more and more skills with behavioral change management. Now, I know many of you don't have degrees in sociology or psychology. You're all what I would call Newtonians, like Isaac Newton, the physicist. I was in the beginning. To us, the world's a big machine. Give me the levers, the pulleys, and dials. What you need to be is somewhat Darwinian, like Charles Darwin, the botanist, the biologist, sense and respond. You're going to need some behavioral change management skills to get buy-in. That rapid prototyping technique is really powerful for doing this, because once they see a vision of what their company's cost of system is going to be like in 2 or 3 weeks, they accept it. They get buy-in. So now I'm going to hand it off to Carlos, and he's going to talk a little bit about what does ABC, how this relates to SAP.
Thanks a lot, Gary. So how do we build all these financial models and cost and profitability models, right? By using a solution called SAP PAPM. So some or most of you have heard about this solution, but SAP PAPM is a highly performance optimized calculation engine that is based on the SAP HANA database technology, right? Which is the same database technology that is used by S4. I'm aware that some of you or most of you have S4HANA. So the application with its different functions is ideally suited to performing profits and cost analysis in near real time. So we have some customers that can manage millions of records in just a matter of seconds or minutes. So in this chart, we can see a summary of what this system can do for organizations through its main engines, as you can see right in the middle, the calculation engine, the business data aggregator, and the simulation application. The system delivers fast and accurate cost and profitability results to set the stage for informed decision making. So as you can see, for example, the wheel on the left-hand side, which is the business data aggregator, it's very powerful. This system can connect to any database, as you can see at the bottom yellow or orange boxes. It can connect to either SAP systems or non-SAP systems. It can manage different functions to grab all the different data, ingest all the different data needed to build all the models. And then the calculation engine, as you can see, is the biggest wheel, because that's where this is one of the bigger benefits of SAP PAPM. As I mentioned earlier, it can handle millions of records in just a matter of seconds or minutes, thousands or millions of products, customers, regions, channels, any dimension. It can manage in a matter of seconds or minutes. Also, another benefit of this solution is that you can start with a blank piece of paper, right? So you build a model any way you want it. And like Gary mentioned earlier, by using a rapid prototyping methodology or technique, you can start building a simple model and then expand it whenever you need it. Also, the other wheel, which is a simulation application, it's an application that's used for what if capabilities, right? So what happens if the cost of fuel goes up or down? What happens if the cost of raw materials goes up or down? How does that affect the cost and profitability of the different dimensions in the system, the different cost objects in the system? So we can actually build in the model all those different features so that we can make those changes and simulate any variable or any component or line item in the model. So I just want to highlight a couple of boxes here. There's a lot of boxes to the left and to the right of the three wheels, but these pretty much they highlight the different methodologies that are able to that are pretty much supported by PAPM. As you can see on the far left-hand side, there's activity-based costing, there's present value, there's market risk assessment and global recharges, life and non-life risk, et cetera, right? So there's different capabilities that this system can handle, including forecasting and budgeting capabilities as well. And then the four boxes at the top, you see scenarios, forecasting, drill down, and auditability. But I just want to highlight the drill down capability because you can pretty much select a specific product or cost object from the model and drill down all the way down to a line item level, right? So for example, you can see the profitability of a specific product, and then you can see all the different cost items that are associated with that specific product or customer. You can see the processes and activities and the impact of the cost on the operational cost of the business of the different cost objects. And then on the far left-hand side of the model, you can see a specific line item like utilities, salaries and expenses, etc. So these are the main capabilities of SAP PAPM. And then in this next slide, as we can see, we have all the different functions and entities that PAPM uses to complete all the different models. So we have different business functions, business helpers, data collection, general entities, structural functions. I just want to highlight a couple. For example, as you can see in the data collection at the top middle section of the page, there's joins. So those joins pretty much, they function the same way as a join in SQL Server or any other solution, right? So it joins in a simple way, it just joins different components from different areas of the model so that you can then complete all the calculations. So it doesn't require any programming. It's just drag and drop in, and this is pretty much the interface, as you can see here. It's just all the bubbly GUI interface. And then on the far right-hand side, you see the data and process integration. So this is where we build all the model tables, where we load all the data from different systems, or even Excel files. We can just upload any data from Excel files. But ideally, of course, whenever we build SAP PAPM models, we typically automate them as much as possible so that we don't have any manual interaction, and we can complete those calculations in just as I mentioned earlier, in just a matter of seconds or minutes. Thanks, Gary. And then as far as advanced modeling, here you can see the wheel on the right-hand side. There's modeling for multiple use cases. And another benefit of PAPM is that it comes pre-built or pre-populated with some sample models. So these sample models, they're just industry-related simple models. For example, if your company is in the CPG industry or the airline industry, you have sample models, not only for you to look at how a model in your industry looks like, but also you can use those as a starting point. Like Gary was mentioning earlier, we can use those as a base for the rapid prototyping exercise, and so that we can get a head start and complete those models as soon as possible. So as you can see, there's different methodologies like tax calculations, business and financial modeling, different types of models we can build, even process modeling, because of course in these financial or even ABC models, we have different processes and activities that we define. So we can use SAP PAPM for process modeling as well. And then as we have, I just want to highlight a couple of items on the left-hand side as well. We can build sophisticated models of complex business process and industry use cases attuned to the unique needs of the business. So I think that's important to mention because like Gary was mentioning earlier, some of the reasons why people retract or don't start to build these type of models is because they think, oh gosh, this is going to take a lot of effort, this is going to take a lot of time and money. But no, I mean, I think through the use of technology and specifically PAPM, it can be used as a starting point or as a base to build these complex calculation engines. And of course, you don't have to build any complex business models, but you can start small with the rapid prototyping methodology, and then you can start building on that model to like a Model 1 version or Model 2 version of the model, so that it is, so that you can get to a specific level for an ideal decision-making process. So Gary, that's what I wanted to add related to PAPM. So for those of you that are interested in learning more about PAPM, feel free to drop me a note and I can walk you through a demo of PAPM and its different applications.
Well, thanks, Carlos. And now those of you who are listening to me know why I enjoy working with Carlos. We've been working together for 5 or 6 years on certain projects. So how does EPM, let me just go up. How does EPM, CPM, and all the various methods fit together? Here's a diagram that I created. Think of it like a circulatory system, like, the blood in your heart in your body. So the resources, that's the big box, that's going to be all your employees and your assets. Notice at the top, I'm going to connect all this, the circulatory system. So be patient with me. But the key point I want to make is customer loyalty at the top. Notice the line goes all the way to the shareholders and owners. That's why trend number one was measuring and managing customer profitability. My point was customers are the source of financial wealth creation for shareholders. So we need to make that connection. But now to the left, start with customers, there's the strategy and mission. That must come from the executives. That's their job. Their job is to set direction. Where do we want to go? And then they will communicate it to their employees with balanced scorecards, KPIs, and the like. That gives the feedback. So to the left, that's the whole strategy management area. Notice the counter clock circle, where it's got ERP, take the customer order, complete the order. That's the universal end-to-end process is order fulfillment, So let me go to the next one. Kind of go put some labels onto this. Let's go back to the big blue box. Now I've got the targeting. See the CRM, customer relationship management? That's why back to customer profitability, what the sales and marketing team is asking is what type of customer is more attractive to retain, to grow, to win back, to acquire, which types are not attractive. So we need to have that customer profitability information to know that. Now we'll back to the strategy management. The executives will formulate strategy based on needs of customer. They'll communicate it with strategy map and balanced scorecard. Incidentally, the balanced scorecard is probably 1/10 as important as a strategy map. If you've got a balanced scorecard but not a strategy map, you missed a bit. The strategy map is where you get the strategy defined, and the balanced scorecard becomes a feedback mechanism. Then you've got the feedback to employees, because of every employee, imagine if every single day they could answer the question, how am I doing on what is important? I'm going to repeat that. How am I doing on what is important? Well, with the balanced scorecard and their KPIs and the targets, they turn on their computer in the morning, they look at their 2 or 3 dials, are they favorable or unfavorable to the dial? But if every employee can answer that question, then how are we doing on what's important? That's the whole strategy management piece. The order fulfillment, that's where lean management, Six Sigma, value add, non-value add, and all of that comes into play. And I'm hoping that the technology here that you're seeing is what I'm seeing, that there are bubbles flowing through the veins in the system, okay? Well, this is what's going on every minute, hour, day, week, month, year. But the problem is, if any of these veins are constricted, I kind of call it arteriosclerosis of the EPM, CPM system, then the money will not flow to the shareholders. It's going to leak in the sewer. So if we got inefficient processes, we're targeting the wrong types of customers, where, acquiring customers that are so, if you will, high maintenance. So we got them, but now we're going to lose money with them. So to me, it's a tribute to the senior executive team, those who will look at this and ask themselves, where should our first priority be? Only they are going to know that. So if strategy management is the problem, we're not executing our strategy, then start with the strategy map balanced scorecard. If understanding where we make or lose money, start with activity-based costing. If process improvement, we need productivity, then move to, lean management, Six Sigma methods. But at least you get an idea of how all of this basically fits together. So I want to contrast the left side to the right side in this diagram. The left side is actually a cover from one of my books. And you'll notice they've got, and it's the performance management, integrating, productivity, sales, risk management, and so forth. Wiley, and I've done 10 books with Wiley, my editor allowed me to pick the cover. And I said, I want greasy, grimy, broken gears. Because imagine if some of the teeth are broken on the gears and they're disengaged from one another, or maybe someone threw sand into it. Imagine you put that into your automobile. what would your fuel efficiency be? Very low. Now look to the right, titanium gears, engaged, lubricated, digitized. Now put that in your automobile. And what's your fuel efficiency? Much higher. Now replace the analogy or metaphor of fuel efficiency with rate of shareholder wealth creation. What integrating all of these methods does is make the revolutions per minute of those gears go, faster, better. And then the productivity from lean management, better, faster, cheaper, safer when we bring in enterprise risk management, smarter when we use strategy management, balanced scorecard. You get the idea. So, action steps, get educated. Thank you very much. You are all doing that by attending this webinar. Get buy-in. You're going to incur resistance to change. So you've got to have some of those social skills, soft skills, okay? Rapid prototyping, start small, think big. I call it crawl, walk, run, fly, soar. When Carlos and I build Model Zero, that 2-day workshop, that's a crawl. Then I typically go home. Carlos stays on for the next 3 weeks. And basically he does a couple of iterations, replacing percentage estimates with, quantified data from business systems and so forth. He's doing the walk and the run, Then we hand it over to the client, to you, and you basically can do the soar, make much better decisions. But you are going to have to basically be concerned with incentives, motivational theory. And incidentally, I'm described rapid prototyping for ABC. I want to quickly describe a way to do rapid prototyping for a strategy map and a balanced scorecard in 1 day. The workshop that I do is I have 5 or 6 executives the night before fill out yellow Post-its, 20 with SWOT, strengths, weaknesses, opportunities, and threats. Then in the morning, they come into the room. I've got on the wall, left to right, the 4 perspectives: learning and growth, the process improvement, to customer, to financial. I said, go put your yellow Post-its under one of those 4. Takes them about 10 minutes, pretty quick. Now I say, go to that same wall, look at the other yellow Post-its that others have done that have similar words, and move them so they're stickies, And what you wind up having is 2 or 3 clusters of the yellow Post-its, those in each of the 4 perspectives. So now you've got your 6, 8, 10, 12 strategic objectives. Then they can basically figure out what would be the KPIs to monitor the progress. See how that was all done just in a day. The 2 links at the bottom, the first one is a 10-minute read, 5-minute read. The second one that says OPEX Society, 20-minute read. My suggestion is download those links and share them with some of your coworkers, your managers, and have a meeting, in conference rooms, debrief about it. So your success depends on how well and how fast the right information and intelligence gets to the right people. Now, I'm going to ask Robbie if there were any questions put into the chat, but if there's not enough time, because we will stop exactly at the top of the hour. It's a courtesy to end. You can directly email me at gcokins@garycokins.com or Carlos, and I'll answer you that way. If Robbie puts any of your questions into a Word document from the chat box, sends it to me, I will answer them in 24 hours. But Robbie, I don't have access to the Q&A. Any questions there?
Okay. Yeah, we do have some time, so let's go through some questions. The first one we received is how can we cover the gap that's used by ABC?
Oh, by gap, I'm going to presume they mean generally accepted accounting principles. Was it spelled GAAP?
No, GAP. So
Ooh.
how can you cover the gap by using ABC?
See, I don't know what they mean by gap, but let me just speculate that what they meant was generally accounting principles, generally accepted accounting principles. Those are things required by regulatory agencies like in the USA, the Security and Exchange Commission. These are rules that need to be, followed. when the accountants spread like butter, the indirect, the overhead expenses, the products and services, it will reconcile to the penny exactly. So when the auditors come in, like Ernst and Young or Deloitte or KPMG, where I was, they'll check in the box. They say that's okay, even though it's wrong in the parts. They're following GAAP. When you do management accounting, you don't have to follow the external regulatory accounting. You follow the internal. So you can basically change different assumptions. So you will get different numbers when you do the management accounting. And that's one of those obstacles that some of the CFOs refuse to do ABC. Oh, I don't want to have two sets of books. I don't want the employees to be confused that when we do our external reporting to the regulatory agencies, the product costs 100, but when we do ABC, it's 135 or it's 44. That's really limited thinking by the CFO. You want to basically just keep safe and keep the managers out of jail with your external auditing, or do you want your managers to have much better information and insights for better decisions? Any other questions, Robbie?
Yeah, so there was actually another on that same subject. So, have you seen any client moving to ABC and later back to where they were before?
No, not that I can think of. Once you make the move to something better, it would be foolish to basically go back the other way. The only time that may happen, and maybe, I'm 74 here, is when a new CFO, the CFO that successfully implements ABC gets to another company because they've been so successful, and then the replacement comes in who's an old line thinker who says, oh, this is complicated. Oh, it's too much work. I don't want to do it. And then they abandon the ABC. Shame on them.
Nice. Okay. Another question is, if I'm not using SAP-SD for invoicing and I have an integration to a specific industry sales solution, do I have options to use PAPM?
Yes, I think I answered that one online, but yes, I mean, SAP, that's sales and distribution. Yeah, the good thing, of course, about PAPM is that you can actually connect to any non-SAP system, and you can load any manual data, right? So if you're missing any important data from any system like SAP SD, you can actually either upload it from a different system or you can upload the data manually.
Got it. And looks like we have time for just one more question. So, another play on the ABC. How long has been the fastest and slowest ABC adoption?
Well, the fastest is when Carlos and I do the rapid prototyping in Model Zero, that's 2 days. I go home. Carlos then stays for 3 weeks. I would argue they now have an implemented system in 3 weeks.
Mhm.
They can start using it for insights, making decisions, rationalizing which customers to grow and all of that stuff, you know. But even when the traditional consultants, the EYs, the Deloittes, they're going to take longer for one reason. They want the billable hours. They want to be there for a couple of months before they hand off the system, but they're still going to have at that point a permanent repeatable production system. So, the answer could be, excuse me, anywhere from 3 weeks to, let's say, 3 months.
Understood. Well, we're at time. There is one more question, but we may not be able to get to it. So we'll be sure to follow back with that.
Yeah, it's a courtesy to end. You people came for just 1 hour. I don't want to keep you 1 minute over. So thank you very much for attending, listening to Carlos and I. Feel free to directly communicate. Oh, you can also go to my website, horizontal tabs. Under it are many, many free articles. So thank you, Robbie, and for Paul Ovigel for inviting Carlos and I to present the webinar for ERP Fixers.
Yep.
Thank you.
Thanks, everybody. Thank you,
Brilliant.
Robbie.
Of course. And any
Thank you,
ERP
Paul.
related questions, feel free to visit our website and feel free to reach out. We're on LinkedIn. You can message us directly there. Cool. Thank you, guys.
Thank you.
Thank you.